Yes, good morning, everyone, and welcome to the regional launch of the Financing for Sustainable Development report issued by the UN Secretary General's Interagency Task Force on Financing for Development. So this year's report shows that the unequal ability to respond to the COVID-19 pandemic has had a devastating effect on the economies and progress of developing countries. It also examines how unfavorable financing terms hinder recovery in developing countries and sets out concrete recommendations to bridge the financing divide. So without further ado, please join me in welcoming Hamza Ali Malik, Director of ESCAP's Macroeconomic Policy and Financing for Development Division, to present the global context and thematic chapter findings. So Hamza, over to you.
Thank you, Kavita. Good morning, colleagues. Thank you very much for joining us for this global report produced by the UN system as a whole. As Kavita was saying in her introductory remarks, this is the outcome of what we call Interagency Task Force on Financing for Development, where about 60 international organizations contribute to its preparation, led by Department of Economic and Social Affairs based in New York of the UN, and in close consultation and collaboration with World Bank Group, the IMF, UNCTAD, WTO, UNDP, and several other organizations. The findings of this report form the basic background document that helps the intergovernmental discussions at the forthcoming ECOSOC Financing for Development, which is which is expected to take place on 25th to 28th April. So this is just for your interest, the basic context of where the report is produced. Can you put up the slides, Pat, please? Okay. Thank you. So I'll be sharing some initial overarching remarks, and then I have also been joined by my colleague Alberto, who will take you some of the details of some of the policy recommendations. As I was saying, this presentation basically is the production led by DESA on behalf of the Interagency Task Force on Financing for Development. Next slide, please. Next slide. So the theme actually this year is about bridging the financing gap, and I'll try to explain what that means and why it is becoming all the more important. But first of all, let's put things in a bit of a context. What is going on? So the last 2 years, the world economy has been experiencing serious and very devastating shocks, both which has impacted the socioeconomic landscape of countries, especially in developing countries, and have had serious financial implications in terms of the pursuit of sustainable development goals. First, it was the COVID-19 pandemic, of course, which started in 2020, and economies have still not recovered from that. And more recently, since February, the war in Ukraine actually has again put a stress on multiple fronts on the global economies. So some of the challenges that countries were already facing were not completely overcome when a new wave of shock has come in the form of higher commodity and energy prices, acute supply bottlenecks, increased financial market volatility, and so on and so forth. What this is doing is this is tightening the global financing conditions quite a bit amid rising inflationary trends. So rising inflationary trends, I'll explain a little bit, essentially means the interest rates are likely to go up across the globe, and they've already started increasing in many instances. At the time when country needs to borrow more to support recovery efforts on the front, right? So this is what means we're tightening financing conditions. Many developing countries are facing now risk of a lost decade for sustainable development. This is a message that UN has been putting out in various reports since the Asia Pacific Asia Pacific Sustainable Development Forum took place last week of March. We had launched a report there on SDG progress in Asia and the Pacific, for instance, showing none of the countries in the region are on track to achieve sustainable development. These kind of shocks are simply making it much more difficult to effectively pursue sustainable development. So now countries are actually facing lost decade of sustainable development. If you only look at the perspective of financing, which is an important means to actually implement sustainable development, we can appreciate how hard it's going to be for many countries. Right. As I was saying, monetary authorities are facing difficult choices now. So at the one hand, they would like to support the recovery efforts by essentially keeping interest rates low. But in the face of rising inflationary pressures, which were happening prior to the war in Ukraine, it's going to be increasingly difficult for them to do so. So this will actually put upward pressure on financing conditions going forward. So if countries want to access markets and raise additional funding, it's going to be very, very costly for them to do so. And that's a kind of, it's going to create a lot of what we call in economics trade-offs. So if there are risks of capital outflows, debt servicing costs are going up, and I'll share some numbers. They're already on the rise, and then poor countries are being affected more. Another recognition that UN is very particular about in highlighting that there are very explicit interlinkages between economic, social, and environment factors. So when countries pursue economic policies or devise their economic plans, they need to bring in economic, social, and environment consideration and not just focus on economic recovery efforts alone. Just simple example, climate-related shocks, for instance, affects the very large landscape or development landscape of most countries across the board, and it disproportionately affects the poor and vulnerable elements of society within a country and most vulnerable countries across countries as well. Next slide, please. So the thematic chapter of this FSDR report focuses on what they're calling it the Great Finance Divide. What it simply means is fiscal constraints in developing countries are driving a widening pandemic recovery gap. In simple words, developed countries had more resources to begin with, more fiscal resources to begin with, so their response to the COVID-19 pandemic was much more stronger, number one, and they were able to borrow additional needed resources at a lower cost because the borrowing costs were lower for developed countries. And for developing countries, the opposite is the case. They struggled in having a sufficient fiscal space to come up with very aggressive fiscal responses. And when they tried to borrow additional resources, it came at a much higher cost, right? So despite high levels of debt, only 3.5% of advanced countries' revenues essentially goes to servicing existing debt. On the other hand, for developing countries, they're facing significantly higher borrowing cost. So on average, in their case, they have 14% of their revenues go to debt servicing costs, right? So this is essentially the essence of what is called Great Finance Divide. Countries, developing countries, will actually need more financial resources to be able to effectively respond to the pandemic and the new shock that is coming, but they don't have the resources to begin with, number one. And number two, when they try to access resources, it comes at high cost, as is reflected already what is the situation. 3.5% going to debt servicing cost versus 14% going to debt servicing cost. So in practical terms, what is happening or what has happened, rather than investing in recovery, they actually had to cut spending on critical areas such as education infrastructure, which then has disrupted the prospects of sustainable development goals. Next slide, please. Right, so what do you do about it? So the thematic chapter of this report essentially highlights four broad areas, and there ample discussion within each area. One, of course, is exactly the message that resonates with the Economic and Social Survey of Asia and the Pacific that we published a couple of days ago on Tuesday, which is focus on managing and using available fiscal resources well. We call it essentially smart spending, right? So when there is crunch time, when you have limited resources, when the access to additional forces is costly, you have to pay attention to, policymakers must pay attention to using their existing resources much more effectively, much more smartly. This is what it means. So financing essentially then translates into the intended outcomes, intended development outcomes, and that over time can actually increase their capacity to service the existing debt. The second recommendation is the need for stepping up the role of the international public finance. The official development assistance is one avenue. It has been on a higher level now for this year, but it needs to be much more effective and targeted going forward for several areas. Another, within that international public finance strengthening element, there is a role for development banks within countries to actually try and support national efforts, whether they're for poor recovery or for the pursuit of SDGs as well. Similarly, multilateral and regional development banks such as World Bank, Asian Development Bank can also collaborate and work closely with national development banks to try and focus much more directly on development needs of countries. The third obvious recommendation is how to reduce borrowing costs in markets. That requires a lot of effort within countries, across coordination between fiscal authorities and monetary authorities, and across countries between major international organizations, especially major international players, major international central banks, for instance, because their policies end up having effect on the global economy. So much more coordination is needed. We call them enabling environment. So for instance, if, as I was saying earlier, if inflation is on a rising trend, interest rates are likely to go up. So we have to have prudence in those things. But how do you coordinate with your fiscal authority to be able to do that? Or if the fiscal authority needs to spend more, what kind of liquidity is provided by the system to support those efforts? So much more than normal coordination efforts will be needed by policymakers in countries to try and actually bring down the risk factors, the reduce the borrowing costs in terms of the excess financial volatility that is being experienced now because there is so much uncertainty. The fourth obvious step is to need for addressing debt overhang. Debt overhang means the debt level is so high that countries will struggle incurring new debt to be able to pursue recovery efforts or sustainable development goals. And there are a multitude of policies that can be discussed in that. A lot of countries are now facing increasing debt distress globally. Next slide, please. So just to conclude, before I hand it over to Alberto, here is a visual of what I was saying, essentially the essence of great finance divide. There are two things over here. The blue bars are the debt to GDP ratios of countries divided across four categories: developed, middle income, least developed, and small island developing states. And the orange bar is the interest to revenue ratios. So the top left one is the developed countries, and you can see their debt level is although high, pretty high, close to 120%, but the interest to revenue ratio is actually 3.5%, much lower, 2021, 2022 estimates, right? So they have been able to incur a lot of debt, but the cost of doing that is much low. Middle income countries, of course, are middle income countries. They're falling somewhere in the middle. But least developed countries, if you look at that, their debt ratios are not that high. Actually, less than half of developed countries, a little under 60%. But look at their interest to revenue ratios, which have exceeded 15%. Right? So this is an important point to understand. It's not just the level of debt that matters, it's actually what is the cost you're going to pay if you incur new debt. And for small island developing states, the situation is very similar. Their debt ratios is very, very high, over 100%, close to 120% in fact. And similarly, their interest to revenue cost is again in excess to 15%. So this is the great finance divide that the report calls attention to, and then it discusses several policy proposals how to address that. I hand it over to my colleague Alberto to take you further through some of the details. Thank you. Alberto.
Yep, thank you, Hansa. Next slide, please. Okay, well, the rest of the report is the same every year. So there are like these 7 thematic areas. These are actually the areas of the Addis Ababa Action Agenda, which was the outcome of the 3rd International Conference on Financing for Development in 2015. Actually, this interagency task force had the mandate to follow up on the achievements of the agenda, on the what are the gaps, what policy recommendations should be considered by member states. So these are the same areas as in the Addis Ababa Action Agenda. Next slide, please. So let me start with domestic public resources. So there are a number of actions that can be taken at the domestic level. One is the importance of having medium-term planning for resources, for taxes, and for expenses, and a strong will to implement it. The report notes that the tax to GDP ratio declined in 72% of the countries in 2020 as a result of the pandemic. The reason is that the level of economic activity came down, so tax collection also came down. But at the same time, there are some recommendations to going forward to tackle, the problems of non-compliance with taxes. This is related to the improving tax administration, and then which is also related to illicit financial flows, and also to broadening the tax base. Broadening the tax base means collecting different type of taxes. Many developing countries have very low participation of income taxes, so that is one of the areas that can be increased. The next time is about the importance of tax systems in reducing inequalities. In this regards, expenditure from the expenditure side is also the use of social protection policies is also one way to use fiscal policy to reduce inequalities. Actually, social protection policies are very good, not only in reducing inequalities, but they are also a counter-cyclical policy that can be triggered when the country faces difficulties. Of course, to fund these social policies, social protection, you need to have enough fiscal revenues. The area of gender equality can also be addressed through fiscal policy by utilizing gender-responsive budgeting and gender-responsive tax policies. Next slide. Now, regarding climate change adaptation and mitigation, there is also a lot of potential for fiscal policies to contribute. This is an area that has been discussed for a long time. One of the recommendations is the pricing of carbon emissions. That can be done through carbon taxes or through implementing a carbon market. What basically it will do is create less incentives for the production of polluting industries, carbon-intensive industries. So the reducing fuel tax subsidies is of course a complementary, but it is important to keep in mind that fuel subsidies play a social role, because for many people it's very difficult to afford fuel. So these type of policies need to be accompanied by support for income groups that will be, will suffer from this change in relative prices. And the other is the use of regulatory instruments to promote a sustainable economy. So you can use both price and regulatory instruments. With regards to international actions, the international tax cooperation is very important. This is related to sharing tax information across countries. And in particular, it's important to facilitate the understanding by low-income countries and least developed countries about new modalities arising at the global level in taxation. Next slide. And finally, combating illicit financial flows. That for that it's important that to improve the flows of information within the country. This is also related to the improvements in tax administration that I mentioned before. In addition, it is also improving public financial management and better procurement systems to prevent corruption, as is also very important to reduce leakages from the fiscal from the budget. Next one. This is the second area, private business and finance. There is some good news that foreign direct investment rebounded 77% in 2021 compared to the previous year. However, this rebound was uneven, and the outlook remains uncertain. So, on this regard, policymakers may need to reconsider investment promotion policies, and it's a good opportunity to refocus these policies into new areas like digitalization and climate change, and addressing climate change. With regards to financing infrastructure, there was also an increase in 2021 compared to 2020. So overall, we see that there has been some progress in 2021. However, as Hamza highlighted at the beginning, the outlook for 2022-2023 looks a lot more uncertain because of the war in Ukraine. Next slide. Regarding the financial sector is not only the big ticket items like the big loans and so on, but it's also important to finance small and medium enterprises in the economy. And for that, these SMEs, small and medium enterprises, tend to have a lot of obstacles to access finance. Also, there are excluded groups like women, and it is important also to address this issue so more finance can be provided to these sectors, and that will also support economic progress. Regarding thematic bonds or sustainable bonds, there was a remarkable increase in the issuance in 2021 compared to the previous year. There was a doubling in the volume of issuance, and now the total outstanding value of thematic bonds is $1 trillion. At the same time, there was also an increase in the investments in the sustainability theme funds. These are mutual funds that invest in companies that have some impact on sustainability. Next slide. So what can be done to improve the situation, the provision of finance by the private sector towards sustainable development? So there are a number of policy actions that are advocated in this report. The first one is to take policy measures that make unsustainable business less profitable. One example is the pricing of carbon that I mentioned just before. Improving the quality and comparability of companies' sustainability reports, that's also very important. There is an interest by investors in investing in this type of products in companies that follow good sustainability policies or have good sustainability products. But the difficulty is to assess how sustainable they are. So there has to be more regulation on how this reporting is done and ensure that they are consistent. The use of taxonomy is now starting in the EU, but many other countries are doing the same. Is one way to homogenize, how to assess different economic activities and how they contribute to sustainable development goals. It's also important that products that are marketed or labeled as sustainable actually are sustainable. And for that, there has to be some norms and criteria for this labeling and for this, to make sure that this is clear. This is the problem of greenwashing, that there are some companies that claim to be sustainable, but it might be just a bit of marketing. So it is important to have a clear information for investors on what is actually sustainable or green. Another option is to require pension funds and financial advisors to ask the beneficiaries and clients about their sustainability preferences. So, for example, if you go to a financial advisor to want to open some investment account, the financial advisor will typically have a form where they ask you about your preference in terms of risk, in terms of how long do you want to invest, at your age, things like that. So why not adding also questions about sustainability? That is a proposal in this report. The next one is to request or even mandate institutional investors to disclose the sustainability footprint of their portfolios. There are some institutional investors actually that are taking this very seriously. There is the Asset Owners Net Zero Alliance, for example, and they have a joint commitment to improve the sustainability of their portfolio. So they are working together with that, and they often put pressure on companies to provide information about the sustainability of their operations. Okay, and we would like to go to the next slide, please. With regards to international development cooperation, there was a good news in 2020 that ODA rose to record high level, but still the perennial issue of donors not meeting the commitment of providing 0.7% of the GDP is still not done. This is something that comes from the Monterrey Consensus, the first global international conference in financing for development. So this is still an issue. There is also the more recently, the ACT Accelerator. This is a program to provide support to countries in fighting COVID-19. That includes therapeuticals, it includes vaccines and other equipments. And it's still not fulfilled, and that's why we have a lot of disparity around the world in terms of vaccinations. Okay, another topic I want to mention is the use of a vulnerability criteria for to complement gross domestic product in accessing ODA. The multi-dimensional vulnerability index is something that has been discussed a year ago in the previous ECOSOC forum for financing for development. And there is great interest among small island developing states in this particular work, because the problem they face is that they have these natural disasters. There are more and more of them induced by climate change. And these disasters can wipe out 30%, 50% of the GDP of a country in just a matter of one day or two. So it is a very serious problem. And some of these countries already have a relatively high GDP per capita, so they are not eligible for concessional loans. So there is a lot of interest by the SIDS to have this alternative criteria that will focus on the vulnerability, and that can be used for ODA, can be used for concessional loans and other policies. There is some progress in South-South cooperation. There's a new conceptual framework that has been agreed last year. Basically, what this does is to create some pattern or some agreement, on how to measure the volume of South-South cooperation. Next slide, please. Then it is important, according to the report, to revitalize the international cooperation in a number of areas. The first two are related to the Paris Agreement and basically the work of the UNFCCC, climate change. That there has been a commitment to provide $100 billion per year for climate actions in developing countries. By the developed countries, this still has not been fulfilled. It is estimated that it will happen in 2023, but this is very important for developing countries. The other is adaptation finance. This is also a more recent commitment from the COP26 to double the adaptation finance by 2025. Another important area is to integrate disaster risk reduction measures into development cooperation. This is again very important for the SIDS in particular that face very frequent and major disasters, and it's important that ODA will have a strong focus on preventing disasters. And finally, when it comes to development cooperation, it's important to ensure that it is focused on LDCs and SIDS, which are the most vulnerable countries. The report also mentions the MDB, the Multilateral Development Bank resources, and there are two particular recommendations. One is to increase the capital of the MDBs. This is a decision by the major donors, and I think it's an important decision that it should be advocated for. But there are also issues about the lending practices of the multilateral development banks, which tend to be quite conservative in general. They focus on keeping their AAA rating, credit rating, in order to get resources at a low cost. But issue has been discussed for quite a while at the G20. The idea is that there are ways to implement balance sheet optimization approaches to allow these MDBs to keep their AAA credit rating, but at the same time to make most of their portfolio. Next slide. And to finalize on international development cooperation, we have the issue of blended finance, which is an important tool. Basically, it's basically public financing supporting private financing in terms of reducing risk or providing, guarantees or things like that. So I would like to go to the next slide, please. With international trade, let me just mention one point because this is important. There has been a rebound, which is quite remarkable in 2021, that global trade recovered and actually surpassed the pre-pandemic levels by 11%. But however, the war in Ukraine is now creating a serious situation. Hamza mentioned this very briefly, particularly because it's triggering an increase in the prices of fuel, wheat, other food items and fertilizers. And this is immediately impacting a lot of developing countries that are importers of these products. The other thing is kind of good news also, but now with this new development, we don't know what will happen, is that there was a major disruption in logistics in the global value chains during the pandemic that is gradually being corrected. But now we don't know what will happen because the global situation becoming very complicated again. Go to the next two slides, please. Next slide. Next slide. I will skip this part because it's getting a bit late. Go to the next one on debt. Yeah, that's the last one I would like to discuss. So global debt, public debt increased quite importantly in 2021 and now reaches 99% of the gross world product. But there's a very, very marked differences across developed countries and developing countries. In the case of developed countries, the debt increased by 18% points, which is huge. If you go then to emerging countries, to low-income countries, you will see that the increase in debt was much less. But the reason is that these countries don't have access to borrowing at the same level, at the same convenient level and low cost as the developed countries. This basically brings us back to the topic of the great financial divide that Hamza already presented. So the access to debt, I think it was very important. There was a lot of emergency financing by IMF and the NDBs, and there was for countries that had market access, they were able to refinance their debt at a very, very low cost. But again, this is very uneven across countries. Some countries don't have that access, so the situation is very different across countries. The other thing that there has been an increase in the countries, low-income countries and LDCs that are assessed by the IMF and the World Bank to be at high risk of debt distress or in debt distress. At the moment, 60% of these countries are in that classification. And this is quite high compared to the situation maybe a few years back and before the pandemic. The war in Ukraine is exacerbating debt challenges. Again, Hamza anticipated this point. There is a serious risk that interest rates are going to go up. Central banks, the major central banks already announced increases in rates. It is a very difficult situation in the US. The interest rate is, the inflation rate, reached 8.5% this last month, which is a record. And the interest rate of the Fed is still around, I don't know, maybe 2%. My macro colleagues will know this much better than me. But there is a huge gap. So the question is, how strong should central banks go to control inflation? But they cannot go very strong because they are going to cause a global crisis. So it is a very, very tricky situation that is not clear how it will be resolved. But one thing that is sure is that the cost of financing is going to increase. Maybe not dramatically, but it's going to increase. And this is going to be difficult for many countries. And taking into account how many are, at risk of debt distress, this can perhaps trigger a systemic debt crisis. Next slide. So how to solve this complicated situation? Well, one thing that needs to be done is to improve the global debt architecture. During the pandemic, the G20 proposed a common framework for debt treatments, which is a very good idea. at the moment is eligible countries are only low-income countries and LDCs, but the implementation is still lacking. There has been only 3 countries, 3 African countries that were already in default that applied to the common framework. They applied more than a year ago, and there still hasn't been a resolution. So there need to be improvements in a number of things. One is the clarity of the process to understand exactly how it works and what countries need to do, how the process can be made effective and fast, so it can resolve this situation as quickly as possible. Another important point that is not in the original design is to add a standstill during the negotiation between debtors and creditors. This is very important because if the debtors has to continue paying the debt during the negotiations, then the creditors will be in no hurry to settle and to agree for a resolution. So this is an important point. The common framework also makes a big point that the private creditors will have to have the same treatment as public creditors. But it is not exactly clear how this is going to work, or how private creditors are going to be mandated to accept the same terms as the public creditors. And the last point is to expand eligibility. There are many middle-income countries that are in debt distress or very close to it. And if the interest rates increase even more, they will need support. And at the moment, the common framework is the only thing, pretty much the only thing there is. There's not much more in this area in terms of debt architecture. This is in terms of the most urgent situation of addressing the restructuring when needed. But there are a lot of things that can be done to improve debt issues over time by increasing transparency of debt, by improving the management, the debt management. These are things that need to be done also to prevent episodes of very fast debt accumulation that can become unsustainable. And I'm finished right now. The last point I want to make is that I want to repeat again the definition. Can you please, colleague, can you please mute yourself? Thank you. So the MPI that I mentioned can play an important role. And I mentioned some uses. It can be used for ODA, it can be used for concessional financing, but it can also play a role when there is a debt restructuring. It can also provide information for debtors and creditors to agree on how much is needed. Okay, I will finish here. You can go to the very end, the thank you slide, if you wish. So you have something. Yeah, thank you so much, everybody. I leave it back to you, Kavita. Thank you for your attention.
Thank you so much, Alberto, for those very insightful findings. So we'll now be taking on questions from the floor. If you do have any questions, please feel free to post them in the Microsoft Teams chat box here. And if you also have any thoughts of some of the findings that were presented. In the meanwhile, we also received some advanced questions in the registration form. So Alberto and Hamza will take on those advanced questions first. Hamza, the first question actually is to you, I think, since you set the global context. And this is probably a question that everyone has on their mind. How far has COVID-19 and the Ukraine conflict set back the 2030 Sustainable Development Goals? Were we ever on track despite such shocks?
Excellent question, very timely one, important one. Short answer is no. The region and the global economies are not on track at all, even before the pandemic and even before the Ukraine crisis. This is an important point. So regardless of these new shocks, the region was not on track. From UN's perspective, we have been, or from the financing perspective, that's what we're discussing today. We have been advising countries to step up their efforts to channel investments towards SDGs for a while now, right? Both pandemic and Ukraine crisis has simply exacerbated the extent of these challenges. I think in our SDG progress report, we show, according to the methodology we present, that at this pace, we are unlikely to meet the Sustainable Development Goals before 2060. So we are at a serious risk of meeting the Sustainable Development Goals by 2030. And Ukraine crisis or war and the pandemic has simply made it much more challenges. So the global community really has to step up their efforts big time to bring things back on track.
All right, thanks, Hamza. Alberto, anything to add to that?
No, I agree. I think that's exactly what I know as well. Thank you.
All right. So could you maybe tell us a little bit, and I think, Hamza, this is probably more a question for you as well. What is the role of tax reforms in domestic resource mobilization?
Oh, this is fundamental, actually, because what we have talked about today, and Alberto took us through a lot of very useful details, the high debt distress, the financing gap, financing divide we're talking about between developing countries and developed countries. So in simple terms, as I was also trying to explain, what is happening is developing countries need to have more fiscal resources to support recovery efforts, right, to pursue SDGs, but they don't have those resources. That's one. B, when they try and access markets to raise additional debts, that comes at a very high cost, which in turn adds to the debt servicing cost. So another challenge that they end up actually facing when they have to go after trying to pursue sustainable development goals. So in the nutshell, what can you do? Where can you come up from additional resources? And that's where we look at the domestic revenue mobilization efforts that become critical. And many developing countries, according to our several researches, including by ESCAP, have a lot of potential to actually grow from multiple angles. Improvement in tax administration is one area we can really bring in a lot of revenues, for instance. Changing the ratio between direct taxes versus indirect taxes and going more towards progressive taxation actually can bring in much more resources. Not just resources, by the way, can actually help you facilitate much more effective pursuit of SDGs itself. Consideration of environmental taxes and additional sources of financing revenues can be generated from those areas as well. So focus on taxation actually gives you the ability to sustain higher fiscal spendings over time and the ability to backstop your debt servicing cost over medium to long term. In turn, it translates into low risk premiums as well if the country's tax efforts are strong. So that's one reason you see developed countries difference between financing risks, essentially, right? So tax actually tend to be, or ability to raise taxes actually is one of the key backstopping principle that facilitates that. So it's one of the fundamental areas of reform for sure.
Right. Thanks, Hamza. So Alberto, next question over to you. Does this report contain data from the Pacific countries? And I know recently ESCAP co-hosted the Pacific Debt Conference, which you were a part of. Could you maybe also then elaborate a little bit on some of the issues faced by small island developing states?
Sure, of course. Yeah, there is data on the SIDS in general, not broken down by Pacific, Caribbean or other parts. So the data that Hamza showed at the beginning, the debt to GDP ratios are higher in the Caribbean region than the Pacific. So this some heterogeneity across a different type of SIDS. But yeah, there is a lot of information relevant for the SIDS, and I think it's quite interesting policy recommendations. Yeah, on the debt conference we finished last week was quite interesting too. There is a lot of concern about debt in the Pacific Island developing states because these countries are extremely vulnerable, and they were also hit, by the collapse of the tourism and travel industry during the pandemic. So it is a very, very complex situation. But one thing that is important to understand about the Pacific is the relationship between climate risks and financial risks. Because there is no much support. There is support for loss and damage when a disaster hits, but it's never 100%. So the costs are huge, and many times these countries need to finance part of this cost through additional indebtedness. So this creates a major problem because by borrowing more to finance the recovery from a disaster, they are actually reducing their fiscal space, which is not needed, because they need to allocate fiscal space to service this debt. So this is a very important area that was discussed. There were a lot of things. I mean, I probably will recommend participants to go to the event webpage, and they can see a number of papers and presentations that are posted there. Thank you.
All right. Thanks, Alberto. So Hamza, What is the new outlook post-pandemic?
There are three areas we are looking closely, and we shared our initial assessment the day before yesterday in the launch of the survey, Economic and Social Survey we shared in the Pacific. One is the inflationary pressures. Globally and as well as in Asia and the Pacific, many economies have not faced these kind of inflationary pressures in a very long time. They're on the rise now since I think beginning of 2021, and the recent developments in the Russia-Ukraine crisis context have actually simply exacerbated those challenges. What it translates in the financing world essentially is the prospect of rising interest rates. That's one reason, coming alone from inflation. Then number two, at the same time, global, as Alberto also alluded in his presentation, globally, US has already started increasing interest rates to stem inflation at their level in their economy. And as a consequence, many countries will have to follow suit because if they don't, there are risks of capital outflows from the region. So another angle or channel through which interest rates can go up. Higher interest rates simply means your borrowing costs are going to go up, or your ability to borrow additional amounts is going to come at a higher cost, right? So for the financing landscape, it's going to create fundamental challenges. So that's one area of concern. The other is how the economies are now going to shield their, how the policymakers are going to shield their economies from the effect of these crises, right? So for instance, if commodity prices or food prices in particular are going up, governments tend to provide subsidies to shield the consumers or lower segments of society from the rising food prices. But the ability to provide subsidies again depends on their fiscal strength, fiscal positions. Do they have enough fiscal space? And that fiscal space has been already squeezed because of the efforts on the pandemic front. So the room to maneuver is very limited, and that is something we need to monitor very, very closely. The third is the overall volatility of financial markets. This already being seen purely on risk perceptions. If you look at the daily bond sovereign yields for some countries have nothing to do with the crisis, have already gone up considerably because of risk perceptions alone or by investors. So there's a volatility happening there. And B, because actually their risk premiums are already quite high in the market. Another element on top of the rising interest rate prospects coming from inflation side. So there's three areas we are looking quite closely: inflationary trends and what the monetary policy authorities are going to do. One, number two, how and when and can they do shield the consumers from rising commodity and food prices in particular. And three, what is going to happen in the financing landscape and the financing conditions going forward because of multiple angles, risk perceptions alone, rising interest rate scenarios, and so on and so forth. So there are three key areas we want to focus on when we want to assess outlook. Impact is going to be dampening of growth prospects for sure, rising inflation for sure, and then, of course, they're going to spill over to links with the prospects of sustainable development goals. Excuse me. Thanks.
Right, thanks, Hamza. And I think in your response just now, you also covered a little bit on balancing interest rates, which our colleague Wei Zun has posed a question in the chat box. So I think that was pretty well answered there. The next question that I have is from our colleague Paul Martin, and he asked, what is the position of regional trade? So the presentation indicated an increase of trade. How much of this relates to direct US PRC trade based on the US COVID stimulus? So over to you, Hamza or Alberto, whichever one wants to take this on.
I can take that. It's not directly related to the stimulus actually part there. Of course, it has some impact. What we've seen and we have documented in detail in the economic survey that we have actually seen a surge in external demand faced by Asia Pacific countries, right? So as a response, the manufacturing, both on the LSM, the manufacturing and services PMI, the monthly data that we actually see the surge responding to the surge in external demand. You can say coming from US, for instance. China tends to be one of the major trading partners of US, right? But the ripple effects in the region tends to be even multifaceted. So for many countries are actually closely trading with China. So in simple terms, they're actually supplying the inputs, China is producing and selling them off to US. So there are links between these kind of things. So as a whole, we do see surge in trade flows in the region so far. The data that we have, I think it was at till end of December or something.
Right, thanks, Hamza. So some of the questions that are coming up also are about tax. And I think Paul mentions here that one policy option that appears not to have been considered is the introduction of flat rate regimes. It's less costly than having incremental and multiple tax regimes. So any opinions on that?
That's an area, there's no universal formula or rule I think that should be followed. It varies quite a bit from country specific context, their economic structure, their history of having different kind of tax regimes and so on and so forth. The principle is okay. The less the different tiers of taxation, the better it is. That's the general principle. But just to have an absolutely flat tax regime, I'm not sure many countries are absolutely ready already to implement that. This kind of specific discussions I don't think so has been discussed because a very specific minor one policy instrument that can be considered. But my own understanding is I don't think so. It can be recommended as a general principle for all countries to consider. But certainly, principle being avoid multiple tiers as much as you can. Can you bring it down to one? I don't know. I doubt it though. There's another question by I think on taxation. If you don't mind, I can take that one. By Imtiaz, I think it says, right? So essentially,
Yes.
it essentially deals with the, it says, what about the accessing the trillions of dollars stashed away in tax havens and taxing armed dealers and so on and so forth. I think the question is essentially talking about what we call illicit financial flows. There is a lot of work going on for several years now, both on the technical front in terms of methodology, how you define, how do you measure. It's not easy actually to do that. There has been it's a heavily political area, so there's a lot of resistance on that. There's a lot of consensus building that needs to take place, and discussions are going on that front for sure, big time. More recently, especially in the context of COVID-19 pandemic, when all we're talking about is limited fiscal space and how you can come up with additional resources, right? So this has again gained a lot of attention. So last year, or not last year, 2020 actually, in the context of COVID-19 pandemic, the Deputy Secretary General of UN formed 6 actually clusters or discussion groups to pursue where we can come up financing different financing sources. And one of them actually task force where multiple UN agencies are working is essentially on how to tackle illicit financial flows from multiple angles. In ESCAP, I can give you an example, trade facilitation, paperless trade facilitation avenues actually is one area which can facilitate reduction of these kind of leakages, money getting stashed away in as Imtiaz puts it, into tax havens, right? So the very first step is actually how you define what it is, because there are some legal practices, but they can be avoided. And then there's which are harmful though. But then there are issue of illegal and how you define that. So that is coming now to a conclusion in terms of a consensus of having a clear definition and methodology, which will then lead to actual formal measurement of these leakages. That's for step one. Then you come to the policy proposals, what can be done actually to tackle that. And that area is very much alive and much more active, I would say, given the urgency to raise additional fiscal resources to deal with the pandemic and many other areas, for instance, to effectively pursue sustainable development goals.
Right. Thanks, Hamza. So coming to, you've touched a little bit about all the risks that are there. So Alexandra actually has a question about market access and risk premium. So can you comment on the extent to which market prices fully reflect climate risk and conversely positively reward climate action?
I can take that.
Go ahead, Albert.
Yeah, this is a very good question. There has been a lot of discussion over the last 5 years or so about the financial disclosures, right? This discussion is mostly in the area of banking regulation of the banking sector, and it started because if a bank is lending to, for example, to oil companies, right? These assets that the oil company has in the future can become stranded if there is a strong, push towards combating climate change and the company cannot extract the oil anymore. So that can create a lot of risks in the portfolio of some banks. And so there has been a lot of debate about this, of making these disclosures mandatory. So this is a particular context of banking regulation, but I think that the same story applies to other markets. And the thing is that you need to have some regulation, some regulatory regime to make this information available. Otherwise, it's very difficult for market participants to know exactly what is going on, right? So I think that I don't think that currently the risk premia is very accurate in pinpointing this climate risks, but it can become more precise if there is more information available to investors. Thank you.
Yeah, just to add a small point, very good, very specific detail by Alberto, but something from the slightly different angle. There has been a proposal, and it is discussed in this report as well, to revisit the debt sustainability analysis of countries after accounting for these risks. So rather than having a short-term view, the DSA, the debt sustainability analysis, should have a long-term perspective, which brings into elements like these, like climate risk and so on and so forth, or the need to invest in climate adaptation and mitigation projects, which will of course require much more fiscal resources. But the proposal is to actually build in these considerations in the DSA and then do the assessment. And one potential understanding is it will actually lower the risk premium associated with some developing countries, because some countries are facing those risks much higher. That's another way of looking at the issue of risk premium that we are facing.
Great. Thanks, Hamza. So I think we have one more question that came in from Imtiaz. As the Ukraine crisis has been mentioned repeatedly, well, he brings back this idea about the arms dealers. So what is being and can be done to tax arms dealers?
Oh, directly arms dealers, I honestly don't know. That conversation I'm not part of. I was sharing the part of the conversation that I have been supporting from the ESCAP side with the other UN colleagues. The efforts are being led by our colleagues in DESA in New York. There's an International Committee of Tax Experts that is supporting that work of the UN. There's a much more active work going on in the African continent, led by our regional commissioner in Africa, even in the Lebanon, in the Southwest Asia. ESCWA is actively working on that. But directly talking about how to that arms dealer, Imtiaz, my apology, I'm not aware of that conversation, to be honest. So I won't be able to comment on that part. It should be handled, how it should be handled, how to approach, where the conversation should start. I'm not aware of that. So I try to bring in the overall spirit of the question, which was around tackling illicit flows, money getting stashed away, and how to stop doing that, right? So taxing arms dealers may be a distinctly different area. I understand that, but I'm not aware of the conversation on those.
All right, thanks, Hamza and Alberto. So we've got like about a minute to go. Last thoughts for the Asia Pacific region. Where do we go from here?
Well, I think that's the road looks a bit bumpy going forward, but we have to carry on. What we are doing. I think that this crisis situation can be perhaps a stimulus, to try to do more in improving the use of finance for the SDGs. So we can take this as a motivation rather than as becoming, depressed and not wanting to get off the bed or something like that. Yeah.
Let me add a 30-second point addition to exactly what Alberto said. So just to give you a number, when we estimated the investment requirements for SDGs across Asia Pacific back in 2019, a number was 1.5 trillion per year. Around 5% of GDP of the average GDP of Asia Pacific. The actual spending countries have done, Asia Pacific countries have done, as a response to the pandemic was 1.8 trillion in 1 year. So which shows if push comes to shove, countries actually have the wherewithal to respond through fiscal resources. Why they're not doing that for sustainable development goals as a whole? So the argument that countries don't have sufficient resources, I think, to me, doesn't hold. What the constraint is, the priorities actually are still not aligned with the importance of sustainable development agenda. So our fundamental message has been countries must invest in people and the planet, which essentially not only brings out social and environmental benefits, but then economic benefits as well, and supports the entire sustainable development agenda. So there's no trade-off involved in these things, and countries have demonstrated in the context of pandemic that they have the resources to do that, and they have done it. So our fundamental message is prioritize these investments much up there, and you have the means to do that. That you have shown that to do that. Of course, developing countries will require more support and effort, collaboration. That's why regional and international cooperation is so important.
All right, thanks, Hamza. So invest in the people and the planet. So I think on that note, we will wrap up today's regional launch. Thank you everyone for joining us. And if you have any follow-up questions, please feel free to send it to us via email. We are available at escap-scas@un.org. The report is now available online, as well as a wide range of resources on the report. So do feel free to check that out. So thank you everyone, and have a good day ahead.
Thank you.
Kavita, you have some.